You know, when you picture the classic American dream, there's almost always a house involved in that mental image, right?
Oh, absolutely.
You picture the yard, maybe a driveway, and definitely a front door that belongs exclusively to you.
Right, the whole picket fence ideal.
Exactly. But for anyone looking at the housing market right now, trying to actually buy that house, it feels less like a dream and more like, I don't know, trying to solve a Rubik's Cube while blindfolded.
Yeah, while riding a roller coaster.
Right. Because the variables are just constantly shifting under the buyer's feet.
They really are. You've got interest rates jumping around, inventory just completely hiding, and prices that are, seemingly defying gravity in a lot of markets.
Which is exactly what we're getting into today. Welcome to the deep dive. Our mission today is to examine how a nearly 70-year-old American institution, KB Home, is navigating this incredibly turbulent 2020 sucks housing market.
It's a fascinating case study.
It really is.
Mm.
And our primary source for this is their hot-off-the-press first quarter 2026 investor presentation. And listen, if you are worried we are just going to look at dry, boring financial slides for the next 15 minutes,
Please don't be.
yeah, don't be, because we aren't.
Right, because this data actually tells a very human story about how a whole generation is trying to adapt to, really harsh economic realities.
Exactly. We are unpacking how massive demographic shifts, very intense economic crosswinds, and a highly unique built-to-order business model are all colliding right now in the pursuit of homeownership.
It's a perfect storm, really.
It is.
Yeah.
Okay, let's unpack this. Before we look at the brutal financial headwinds that hit the industry in early 2026, we need to lay down the foundation.
Right, the basics.
Yeah. What is KB Home doing differently from other massive corporate home builders to actually attract you, the modern home buyer?
Well, the first thing to understand is their footprint and who they are actually building for. So KB Home currently operates in 49 markets across 9 states.
Okay, so pretty spread out.
Yeah, but we're talking heavily about the West Coast, the Southwest, places like Texas, Colorado, Florida, and North Carolina.
The major growth hubs.
Exactly. But honestly, more importantly than where they are building is who they are targeting. They are going aggressively after a massive demographic wave.
The millennials and Gen Zers.
Yeah, the 150 million millennials and Gen Zers who are moving into their prime home buying years right now.
150 million people. Just wrap your head around that demand pool for a second.
It's staggering.
If you are listening to this and you fall into that millennial or Gen Z bracket, you know exactly how crowded the open houses feel.
Oh, for sure. You're waiting in line just to see a 2-bedroom.
Right. And looking at the presentation, KB Home's targeting is clearly working. Roughly 72% of their buyers right now are either first-time buyers.
Which is huge.
It is.
Yeah.
That's a massive 50% chunk right there.
Mm-hmm.
Or they are first move-up buyers, which is another 22%.
And to capture that specific, younger, highly price-sensitive demographic, KB Home leans entirely on what they call their built-to-order, or BTO, model.
The BTO model.
Yeah. What's fascinating here is how this model completely subverts the traditional entry-level housing market.
How so?
Well, usually affordable housing means buying whatever the builder decided to build on a speculative basis. Like they build a neighborhood of identical houses and you just buy one.
Right, a total take-it-or-leave-it scenario.
Exactly. But the BTO model allows buyers to personalize their floor plans. They choose their specific lot, dictate the square footage, pick the exterior elevations, and, select the interior finishes through a dedicated design studio.
So it's almost like ordering a custom laptop online.
That's a great way to think about it.
Yeah, like you start with a base model, and if you want more memory or a faster processor, you pay for it.
Right.
But if you want to keep costs down to fit your budget, you just stick to the absolute basics. It gives the buyer the illusion and actually the reality of control over that final price tag.
And control is the operative word in that custom laptop model. Because for a millennial or Gen Z buyer entering a very tough, expensive housing market, empowering them to control their final sales price by making their own trade-offs is vital.
Right, because budgets are so tight.
Exactly. If you know you can only afford, say, a certain monthly payment, you can sacrifice the upgraded countertops to keep the base price down.
Makes total sense.
And we see how they are managing this affordability factor in the data. A crucial detail from the source is that 65% of KB home communities offer floor plans under 1,600 square feet.
Wait, really? Under 1,600 square feet for 65% of their communities?
Yep.
That is a deliberate, massive pivot towards smaller footprints just to keep those starting base prices low.
It's a huge shift.
Think about that for a second. The average American new-build home peaked well over 2,500 square feet in the mid-2010s. We got so used to the sprawling McMansion as the baseline.
Oh, yeah, the massive dining rooms nobody uses.
Exactly. A 1,600 square foot home is a totally different lifestyle. It means smaller bedrooms, maybe relying on a really open concept living area to fake a larger space.
And definitely fewer spare rooms.
Yeah, it's a generational shift in how we live, driven entirely by what people can actually afford.
And the interesting part is the buyers are responding to that trade-off incredibly well.
Are they?
Yeah, the presentation highlights a 96% customer satisfaction score on AvidCX.
Wow, 96%.
Right. Which is an independent service that surveys buyers 30 days and 11 months post-move-in. And they also hold a 4.5 out of 5-star rating on TrustBuilder.
That's pretty impressive for a builder.
It is. People are willing to accept a smaller footprint if they feel they had a hand in designing it, and most importantly, it actually fits their budget.
Well, it clearly generates brand loyalty. But having a clever, highly popular business model doesn't make a corporation immune to gravity, right?
No, definitely not.
Because while the built-to-order strategy is a powerful differentiator, when we actually look at the first quarter 2026 financial reality, gravity is pulling them down hard.
Yeah, it was a rough quarter.
The company is taking some heavy hits. Let's look at those Q1 2026 numbers, because for anyone holding their stock, they are quite a reality check.
Absolutely. We are looking at steep year-over-year declines across almost every major financial metric. Housing revenues dropped 23%.
23%.
Yeah, falling from $1.39 billion in the first quarter of the previous year down to $1.07 billion.
Ouch.
And deliveries, meaning the actual number of finished homes handed over to buyers, fell 14% to 2,370 homes.
Wow.
And on top of that, the average selling price, the ASP, dropped 10% down to $450,100.
So those top-line revenue drops bleed directly into their profitability too, right? Because the margins just got crushed in this report.
Oh, totally crushed.
Yeah. Home building operating income margin plummeted from 9.2% down to 3.1%, and housing gross profit margin fell from 20.2% to 15.3%.
It's a steep drop.
Plus, the value of their backlog, which is the homes that buyers have ordered but KB Home hasn't delivered yet, that dropped 23% to $1.70 billion. It paints a pretty bleak picture.
It does. But tucked into those declining metrics is one very telling bright spot.
Okay, what is it?
Net orders actually increased by 3% year over year, hitting 2,846.
Okay, wait. I'm trying to synthesize these completely conflicting metrics. Revenues are plummeting, profit margins are in free fall, the backlog is shrinking, but actual net orders are slightly up.
That's what the data says.
Wait, let me push back on this for a second.
Sure.
If the built-to-order model is so brilliant because it aligns sales with starts, meaning they only build what someone has already committed to buy, to avoid that speculative inventory, why are their profit margins getting absolutely crushed?
It's a fair question.
It sounds like they're building fewer homes, making way less money on each one they do build, and dealing with a shrinking backlog. Where is the financial protection that this laptop-style model is supposed to offer?
Well, the BTO model absolutely prevents them from being stuck with thousands of empty, unsold homes that they have to slash prices on to move.
Right, the ghost towns.
Exactly. That speculative inventory is what bankrupts builders in a true housing crash. But BTO doesn't protect a builder from the broader macroeconomic headwinds, the why behind these brutal Q1 numbers.
Okay, so what are the headwinds?
The source material lists several forward-looking risk factors acting as a drag. Let's look at the mechanics of the equipment shortages delaying municipal utility processes.
Right, the presentation mentions that specifically.
Yeah. So think about what it takes to actually finish a house. You can build the framing, put on the roof, install the drywall, and lay the flooring.
The easy stuff, relatively.
Right. But if the city cannot source the specific electrical transformers or the municipal water meters due to global supply chain disruptions, that house cannot get a certificate of occupancy.
Oh, wow.
You literally cannot hand the keys to the buyer. So imagine KB Home has a $450,000 house sitting completely finished, but it's waiting 6 extra months for a $50 water meter.
That is wild.
The builder's capital is trapped in that empty house. They can't book the revenue, which drastically reduces deliveries and revenues for the quarter.
That makes total sense.
Yeah.
The supply chain bottleneck happens at the very last mile at the city level, and the builder's just stuck holding the bag.
Exactly.
And I imagine the persistent consumer price inflation and the Federal Reserve's interest rate policies play heavily into that 10% drop in the average selling price, too.
Oh, they are the primary driver.
Yeah.
Higher mortgage rates mean you, the buyer, can afford less house.
Right.
If a buyer is maxed out at a $3,000 a month payment and interest rates jump, the total loan amount they qualify for shrinks.
So what does the builder do?
Well, to keep the buyer from walking away and canceling the order, KB Home often has to eat some of that difference. They offer incentives, buy down the mortgage rate, or simply lower the base price of the home.
Oh, I see.
And that severely squeezes the profit margins for the builder. They are selling the house, but making far less on it.
They also note global geopolitical instability, specifically citing the Middle East and Ukraine as ongoing risks that disrupt supply chains and increase the cost of materials.
Yeah, it all adds up.
But going back to that 3% rise in net orders, I see why you called that the bright spot.
Right.
It tells us that despite inflation, despite having to navigate high rates, the fundamental demand from that 150 million strong millennial demographic is still there. People still want to buy.
Exactly.
The profitability per home has just temporarily shrunk.
Demand is the bedrock. But, the margin squeeze is painful. To truly evaluate the health of KB Home, however, we have to pivot away from just looking at the quarterly income statement.
Okay, where do we look?
Analyzing a company solely by a single quarter's profit margins is like judging a 500-page book by reading 1/10th chapter. We need to look at how they manage their cash when times are hard. We have to look at the balance sheet.
So if they are bleeding profit margins on every house they sell right now, and their capital is getting trapped by supply chain delays, how are they not panicking?
Because of the balance sheet.
What is keeping this company afloat while they wait for the market to normalize?
Yeah.
Because looking at their balance sheet and how they handle shareholder value, it tells a very different story than the revenue drop.
It really does. It shows a company built to weather the highly cyclical nature of real estate. The presentation highlights total liquidity of approximately $1.2 billion.
Let's break that down for a second because liquidity gets thrown around a lot.
Sure, it's essentially the money they can access immediately without having to sell off hard assets like land. That $1.2 billion includes $200.5 million in actual cash and cash equivalents sitting in the bank, plus nearly $1 billion available on a revolving credit facility.
A revolving credit facility is basically a massive corporate credit card.
Exactly.
They don't have to use it, but having $1 billion limit means if cash ever gets incredibly tight, they have a massive safety net to draw from to keep operations running.
Right. And their debt-to-capital ratio is sitting at a very healthy 32.9%.
Which is good, right?
That ratio is critical. It means that for every dollar of capital financing the company, only about 33 cents of it is debt. They aren't over-leveraged.
Oh, that makes sense.
If you look back at the 2008 housing crash, the builders who went bankrupt had massive debt burdens they couldn't service when sales slowed down.
Right, they just couldn't make the payments.
Exactly. KB Home is keeping their debt incredibly manageable. Plus, they don't have any immediate debt maturity panic. Their next major maturity isn't until June 2027, which is a $300 million note.
So no one is knocking on their door demanding cash tomorrow.
Right. If we connect this to the bigger picture, this is textbook corporate strategy for a mature, cyclical business.
How so?
Well, when the housing market is tough, when margins are squeezed by high rates, companies with fortress-like balance sheets don't panic. They don't desperately overbuild speculative homes to try and juice their top-line revenue.
Right.
Instead, they look at their own stock, realize it's trading at a discount because of the broader market fears, and they buy it back.
Here's where it gets really interesting. KB Home has been incredibly aggressive with this stock buyback strategy.
Extremely aggressive.
Yeah, the source notes they have returned over $1.9 billion to shareholders since Q2 2021.
Wow.
They've repurchased nearly 37% of their outstanding shares in recent years. Just in Q1 2026 alone, they bought back 0.8 million shares for $50 million.
That's a lot of cash to drop in a bad quarter.
It is. Let's put this into a real-world analogy so you can see why investors love this.
Go for it.
Imagine KB Home is a massive pizza, and the total value of the company is the size of that pizza. Every share of stock is a slice.
Okay, I'm tracking.
If the company takes its own cash and buys back 37% of the slices and then completely destroys them, the total size of the pizza hasn't changed. But the remaining slices, the ones you hold as an investor, just got significantly bigger.
Right.
They represent a much larger percentage of the company's total earnings. It's like a farmer using his savings during a bad season to buy out his silent partners, so when the crops come back, he owns the whole farm.
It's a highly effective way to artificially reduce the supply of their own stock, which fundamentally boosts the underlying value of the shares that remain.
Yep.
The presentation points out that their book value per share, which is essentially what each share would be worth if the company liquidated all its assets and paid off all its debt today, that actually increased 8% year over year to $61.53.
That happened despite the incredibly tough quarter they just had. They're using the financial winter to consolidate ownership and artificially inflate the value of the remaining shares. It requires immense financial discipline and a very strong balance sheet to execute a $50 million buyback while your revenues are simultaneously down 23%.
It proves they are playing the long game. They are protecting shareholder value while waiting for the macroeconomic winds to shift.
So we understand how they are surviving the financial winter. They are hunkering down, buying back stock, and relying on that billion-dollar liquidity cushion.
Right.
But what happens when the spring comes? When rates eventually drop or inflation cools, what is KB Home doing to ensure their actual product remains appealing?
That's the real question.
Especially to those eco-conscious millennials and Gen Z buyers who make up the bulk of their market.
That brings us to their investments in sustainability. KB Home has positioned itself as a significant leader in energy efficiency.
Oh yeah, the data on this is huge.
The presentation highlights that they have built over 217,000 Energy Star certified homes over the years. In 2024 alone, they received a record 30 market leader awards from Energy Star.
The numbers in the presentation on this are just wild. Over 28,000 cumulative solar homes. Over 31,000 WaterSense or WaterSmart homes.
It's a massive scale.
And the tangible results of all this, an estimated $1.3 billion in cumulative utility bill savings for their homeowners and 2.2 billion gallons of water conserved annually.
Incredible impact.
But what I want to know is the how behind this. Why is KB Home so successful at pushing solar and energy efficiency compared to someone just buying an older home and upgrading it?
It all comes back to the built-to-order model.
How so?
Well, if you buy a 10-year-old house and decide to retrofit it with solar panels, high-efficiency HVAC, and smart water meters, it is incredibly expensive.
Oh yeah, thousands of dollars.
Right, because you are dealing with existing roof structures, older wiring, and separate contractors. But when KB Home bakes these options into the initial BTO design phase, they are installing solar at the factory and foundation level.
Oh, wow.
The economy of scale makes it drastically cheaper to implement.
And we shouldn't view this merely as a feel-good, save-the-earth PR move, right?
Not at all. It is a core economic strategy. Think about your own monthly budget.
Oh, okay.
For a first-time millennial buyer who is hyper-focused on exactly how much money leaves their bank account every month, a lower utility bill directly impacts the total affordability of the home.
Oh, that's true. It's part of the monthly carry cost.
Exactly. If your heating and cooling costs are drastically lower because the home is tightly insulated and Energy Star certified, or you're generating your own power from factory-installed solar, that offsets the pressure of a higher mortgage rate. It's an affordability hack wrapped in environmental sustainability.
So what does this all mean? When you look at the factory-installed solar panels, the water-saving tech, the app-based design studios where you customize your floor plan, are they even just selling houses anymore?
That's an interesting way to look at it.
Or are they selling an optimized lifestyle product? Because wrapping a home in energy tech and prioritizing supreme square footage efficiency sounds less like traditional 2x4 carpentry and a lot more like a tech hardware ecosystem.
They are absolutely applying modern product design philosophy to traditional shelter. They recognize that the entry-level buyer today doesn't just need a roof. They need predictable monthly operating costs and a deep sense of ownership over the design process itself.
Right.
And they pair this environmental focus with some pretty rock-solid corporate governance, which is highly appealing to modern investors.
Right. The source material emphasizes that heavily. 9 of their 11 directors are independent, meaning they aren't company insiders or executives.
Which is great for oversight.
Yeah. They hold annual elections for those directors, and they maintain only one class of voting stock, meaning there are no supermajority voting loopholes for founders or insiders to overrule the public shareholders.
That level of transparency is increasingly important. Modern investors and, frankly, modern consumers are far more attuned to how a company is governed.
Totally.
A transparent, independently overseen board acts as another vital layer of risk mitigation against catastrophic corporate missteps.
Which brings us full circle on this analysis. To wrap up today's deep dive, we've explored a company that has uniquely positioned itself to capture the largest demographic wave in the country, those young first-time buyers, by offering affordable, customizable homes through their built-to-order model.
Yeah, a really smart strategy.
We saw how brutal macroeconomic forces like persistent inflation, municipal supply chain gridlock, and high interest rates severely squeezed their Q1 2026 margins and revenues.
But we also untacked the defense mechanisms keeping them alive. A fortress-like balance sheet, over $1 billion in liquidity, and a highly aggressive stock buyback program that keeps the company stable and actually grows the underlying book value for the shareholder, even when the broader housing market is contracting.
And they are future-proofing that investment with massive commitments to energy efficiency that directly lower the cost of living for you, the buyer.
This raises an important question, though.
Oh.
The housing market is inherently cyclical. They are weathering the downturn incredibly well from a financial perspective, but the ultimate test for KB Home is operational scalability.
How do you mean?
Can this built-to-order model, which relies heavily on complex, individualized supply chains for each customized home, can it scale back up efficiently without massive municipal delays when the economic headwinds finally die down and demand explodes?
That is the multi-billion-dollar question holding their future in the balance. And it leaves us with a final thought for you to ponder on your own.
Yeah, let's hear it.
We discussed earlier that 65% of KB Home's communities now deliberately offer floor plans under 1,600 square feet just to maintain affordability.
Right, the smaller footprints.
If this trend continues, driven purely by the economic necessity of high land prices, high material costs, and high interest rates, how will that change the very fabric of American neighborhoods and family dynamics over the next 20 years?
Oh, wow.
Are we witnessing the quiet end of the traditional sprawling McMansion era? Not because people suddenly don't want massive houses, but simply because the math of the American dream no longer works the way it used to.
It certainly redefines what that dream looks like for an entire generation moving forward.
It really does. Maybe the new dream isn't a massive, sprawling estate. Maybe it's just a highly efficient, custom-designed, solar-powered puzzle box that you can actually afford to heat. Thank you so much for joining us on this deep dive. Keep asking questions, keep looking at the data, and we'll see you next time.